Welcome back to this lesson. So we are going to learn on how liquidity drives price movement. So in this lesson, basically we have to understand that the market moves from one level to another, and from this level to another we have to understand that the driving force of the market is liquidity. So what the market basically does is that it runs to an area of liquidity from one point to the other, and of course the market has to move from a premium market to a discount market. So for example, these areas of market liquidity in the market, this area of liquidity, the first point is the buy stops liquidity or buy side liquidity and the sell side liquidity. So the buy side liquidity are liquidity found above the current price market, and also sell side liquidity is liquidity found below the market. So when we understand this, we can look further into our charts, and since the market moves from a premium to a discount, we have to understand that market moves from a premium to a discount. So, and the premium markets are any liquidity above the market, and any liquidity below the market is now the sell side liquidity. So if the market moves from premium to discount, so if the market moves from premium to discount in search of liquidity, then in the higher time frame, then it's also the same for the smaller time frames. So this is where basically in scalping and in this session and in scalping session liquidity, this is where the market moves from liquidity that is found in the session zones, either for example the Asian, the New York, or the London. For example, if the market is in a sell, if we are selling in that particular market, then and in that time, maybe during the Asian or the London, the market has to come for an area of liquidity before it moves to the opposing sell side liquidity. So basically what we will look at in the session liquidity, scalping the session liquidity, is we have to determine first the bias of the market. We can't go just trading blindly. We have to understand the current condition of the market. If we are in a premium, if we are in a bullish or a bearish market, then after that we have to understand which area of liquidity is the market most likely about to take out in that particular session that you are looking at. So if it's in the New York session, have we run any form of buy side liquidity if we are in a bearish market? And if we are in a bullish market, have we run any form of sell side liquidity for the market to move higher? So basically what drives the market is liquidity, because smart money see the availability of liquidity, then run to that liquidity, then moves the opposite direction. So even as a scalper, we have to come with the mindset of an institutional trader and trade like the smart money, trade in terms of looking out for the higher time frame liquidity. For example, you can see in this chart, in the daily chart, we are just looking at an example, and I want you to have that mentality when we go into the lower time frame, that in this particular market, you can see that the moment we ran this buy side liquidity, the market immediately broke structure, and then we are running now for the opposing liquidity. We can see also here that when the market ran this relative equal lows, this sell side liquidity here, the market, what it did is we broke structure, retraced back, then ran for the buy side liquidity. So with that in mind, that is the same thing that we want to focus on in the smaller time frames, in the 1 minute, in the 5 minutes. But first of all, remember, you have to understand the direction of the higher time frame buyers before even in scalping, so that you may trade in line with the higher time frame. So that's it for this lesson, and thank you for listening.